Welcome to another edition of Zacks Rank Buy. I am Brian Bolin, and I am the aggressive growth stock strategist here at Zacks Investment Research. And I got two picks for your aggressive growth radar screen, and we're going for the dogs. We're going to the dogs. I don't know how we like to say it. It's not the dogs or the Dow, but it's we're going to be dog focused here today because everyone loves a dog, and if you don't love a dog, I don't know what to tell you. This is not your video. All right, let's go to it. We got Chewy is our first stock. It's Chewy. Woof, that's too big and too black. CHWY, that's the ticker. You can find the ticker right there. It's a Zacks rank #1 that makes it a strong buy. It's got an A for growth and an F for value. I love to see that diversion in growth and value style scores. It tells me right away I'm on the right path. Chewy, of course, is just about a $10 billion retailer of pet goods and supplies. You can always find that little tidbit of information right there in the corporate summary here page on Zacks. Let's go right to the numbers we always love to see on this sort of thing. Are you beating the number? They are beating the number, beating it bigger, not quite beating it bigger. But if we look on absolute terms, earnings have been increasing on an absolute basis. So we like to see that. That's great to see. Past the first check mark. All right, our earnings estimates moving up. So we've got, 19 cents holding still, but 17 cents just from that last earnings report. Same sort of story here, 19 cents. We're going to call that an up, even though it's really a down from 20. So, but at the end of the day, we got the current year, and their fiscal year is in January, and we are moving up a penny, 83 to 84, and then next year, 95 to $1 and a penny. Overall, I'm going to call that good. Not the greatest, but not the worst. This is not a spot that you would expect a lot of growth, pet supplies, but they're able to grow at 5.5% this year, 4.7% next year. I don't like to see that deceleration, but this is a stable thing. People are always going to be buying food for their pets, toys for the pets. So that's why you're paying 26 times earnings with only 3% top line growth in the most recent quarter. Price to book pretty big here at 15 times, and that's what's keeping those value players away. Price to sales at only 0.86 times. That's not necessarily great. And margins are super thin on these dog treats, not even 1%, but trending higher. If we get to 1%, stock probably moves a lot higher. Let's take a look at our chart, and what do we got? Oof, not what I was expecting to see. I haven't thought about this stock in a while, but boy, the thing was up 110 and then back to reality here. But we are basing out and looking good. Looks like it's time to start moving back higher because earnings have really started to trend much higher. So if we can improve margins and keep more of the money that we make, that would be a great thing for Chewy, consumer staples dogs. All right, so going to the dogs, sticking with the dogs, what's our next stock if Chewy was our first? Well, you guessed it. It has nothing to do with consumer products. It's Datadog. Sticking with dogs. DDOG. It's a Zacks rank #1 strong buy. A for growth, F for value. This is an internet software company. I will bring one idea here, but we can see it does all sorts of analytics, IT, and log management, and software as a service, all the buzzwords you want in a software name, right? It is a big cap stock. It is $36.5 billion. Pretty liquid too. We just instant look at the chart. The earnings, boy, we tumbled, and then we've tumbled again more recently. It seems like software has really gotten out of favor here recently. Not what you want to see, but it presents a buying opportunity because they are beating the number. They're always beating the number. Close call here, but back to a nice solid beat. And 36, 45, 44, so we're holding steady here with the earnings. All right, are the estimates moving higher? That's why we buy stocks, because they're earning more money. The outlook is better. 34 cents up to 35 cents, 36 cents flat. $1.42 up to $1.54. We like to see that. 73 cents going to $1.80. That's $1.73 to $1.80. So earnings estimates looking good there. We checked that box. And we see good growth. Good 22% top line growth, 21% next year. That's solid. 2 billion to 2.6 billion, I should say. Sorry, 71 times is a huge amount, but you're growing at 26%. It's a super stable business. Price to book is going to be high because it's asset slim. Price to sales is big because they keep on growing that revenue. Margins, look at this story in the margins. We've really improved. We're losing, we're gaining, and we've doubled. I mean, that's great to see, but this is a software name and everyone expects big margins from them. How about the chart? All right, pandemic is getting out of control here. We're all going to die. We're going up, and we're 22 is our tech rec, and we're starting to respond. Now, recently we've been hearing this idea. This is a crazy idea to me. I mean, it's just that I haven't thought of it. That's what makes it crazy. That's the space is there, your space earnings growth. But people are talking about how AI might be the killer for the software industry. The thing, software is going to eat the world, Mark Andreessen famously said. But maybe that's not true. Software is important to all these businesses. I don't know that AI just yet is going to be doing that. So keep 2 dog names on your list, and it's Datadog and it's Chewy. And that's it for this week. Be sure to join me next week when I look at 2 more aggressive growth stocks for your aggressive growth radar screen. But until then, why don't you go to Zacks.com/promo to check out all of our latest promotions.